So do you own a small business and you're wondering if you can offer a group health plan? You may have more options than you think. Today, we're talking about two types of small group health plans, fully insured and alternative funding. So I'm Lisa Martin. Welcome back to Health Insurance Sherpa, where we help guide your health insurance journey. Today, we're focusing on small employer groups, sometimes called microgroups, and the health insurance options that may be available to them. My guest is one of the most important people on my team when it comes to group health insurance, Chris Keel of Emerson Rogers here in Phoenix, Arizona. Welcome, Chris.
Thanks for having me.
So Chris and his team have supported me and my group health clients for so many years. He really is my secret weapon to stay on top of all the changes in the group health insurance world. So today we're going to cover three sections. First, we're going to cover the fully insured or traditional health insurance group plans. And then we're going to also cover alternative funding for small employer groups with medical underwriting, and then also a very valuable tax credit available to new plans here in Arizona. So let's begin with traditional health plans for employers. This is the type of coverage that many employers and employees are familiar with, the type of plans that offer outstanding coverage, similar to what you get through the individual ACA plans. So, Chris, what are the basic requirements to cover or to qualify for a fully insured health plan, even as a small employer?
That's a great question, Lisa. Most businesses can actually qualify as long as they have two full-time employees. Some carriers will even cover owner-only options, where you could have two owners as the only employees in the company.
Okay.
But all companies are going to need at least two people to be eligible for coverage. As long as you don't have an owner-only enroll, you could theoretically have one employee enroll, a W-2 employee, as being the only one that's covered on an employer-paid health plan.
Okay. That actually happened with me when my dad went on Medicare. So we were a group of one. So it just it can't be married spouses. That's one thing that we run into. Yep. I get that question a lot. It's a family-owned business. Just a couple is in the plan. So they have to have a W-2 employee that's not their spouse.
It's not their spouse, but it could be their son or their nephew or a mother-in-law.
Get someone working part-time.
Yep.
20 hours a week.
25 hours a week is generally the minimum that the carriers are going to require to be eligible for care, but it really depends on the carrier.
Okay. How about if somebody has an out-of-state employee? Is that allowed even if you have a smaller group?
Yes. Here in Arizona, as long as the group is actually domiciled in the state of Arizona, you could have one employee here and one employee in another state. You could have, with a lot of carriers, one employee here and 5 in other states. Okay. There really is a lot of flexibility, even on the fully insured side, as to how you set it up.
I thought you had to have most of your employees here, but that's not the case.
No, it's not the case at all.
Okay,
in fact, some of the carriers actually will domicile the group in the state that has the most employees. So it could actually be domiciled in Arizona, but they could have more employees in the state of Texas that enroll. And some carriers will actually write it out of the state of Texas.
Interesting. Okay. I'm going to stick to just Arizona. I think I've got enough on my plate. So let's say we have a lot of microgroups here in Arizona. A lot of my book, as you know, is, maybe 2 to 3 employees on it. How many current companies do we have offering plans for that size?
So in the fully insured market here in Arizona, we have 3 carriers that will write down to 2 employees, or 2 of them will actually write 1 employee as long as it's not the owner or the owner's spouse, but 3 fully insured carriers here in Arizona.
So they need 2, usually about 2 to going in. But then, like in my case, we had 1 drop off and then we were still renewed and it was fine. Okay. Can you carve out management, or can you discriminate with different classes of employees?
So under healthcare reform that was signed in 2010, discrimination is theoretically a no-no.
Yeah.
So no one actually wants to do a carve out where they're discriminating. However, a lot of the carriers will give you the ability to do what you want, and you could pay the piper later. I never recommend doing carve-outs.
I like to keep it.
I want to keep it smooth and simple and above board. And so I will try to recommend finding a solution for those employees, maybe offering something different, but still offering something.
Like a different benefit?
Yes. Okay. You could offer a different benefit. You could offer different plans, different networks, something that will minimize the cost maybe for the employer, but still offer something to the employees. Okay. As far as a carve-out goes, carriers will write them. Some have minimums, maybe of 5 enrolled in order to actually do a carve-out, where others you could carve out 2 people.
Okay. To keep it kind of simple, I mean, with all of my groups, I think they just offer it to everybody and we just say, we're not going to discriminate and the employer is going to contribute the same for everybody.
Yep.
So when the minimum employer contribution is 50% for the employee and they don't have to contribute anything for dependents. Is that for all three of those
Correct.
companies?
Yes.
Okay. Okay. And then approximately how long does it usually take to set up a fully insured plan?
Well, again, that will kind of
not in a rush.
That's a great point. It really kind of depends on the business. I mean, the sooner that they can get you, Lisa, the information that we need to actually put something together to get numbers and then make a decision, we can get it installed in the matter of days with some of the carriers, or it could get drawn out to weeks.
But I usually say 30 days is a comfortable. But we've done it in a couple weeks before. As long as the group's responsive, for me, I find the hang up could be just getting those forms back to me. Or
and that's usually the problem. The problem is usually the group has other things to do. I mean, they're running a business, and depending on what their schedule is will depend on how quickly you can get things back, which will depend on how quickly you can get it installed. Once we actually get everything together with most carriers, we can have it installed in 2 weeks.
Okay.
In some carriers, a matter of hours.
What kind of documentation is typically required? Like payroll records, wage and tax? What do they usually have to do for these small groups?
Another great question. In the fully insured market, all of the carriers are going to require what we call a wage and tax report. And here in the state of Arizona, that is the unemployment tax that an employer pays.
Okay.
That is filed quarterly. So the carriers are going to require the last quarter of that quarterly wage and tax report. If for whatever reason employees are not on that report, then they will ask for 2 weeks of payroll.
Okay, a new hire or something.
A new hire, yep. They're going to want the 2 weeks of payroll. They're going to want that from a payroll company showing all of the taxes being taken out, the number of hours worked. Okay. Those kind of things need to show up on it. And then if the owners are not on that wage and tax report, they're going to ask for K-1s, Schedule C, incorporation documentation, something that's going to tie the owners to it. And if we have a situation to where we have two owners per se, that are in a business, but one of them is there monetarily only and doesn't actually work, the carriers are going to still want that K-1 because they want to see 100% on the K-1s, and then we just explain that they're not eligible.
Type of thing. Show 100% of who
owns the business.
Yeah.
Yep.
Okay.
You think of it as you want to make sure you tell the story, but they want the complete story. And so they're going to make sure that everything jives to make sure that's a legitimate group.
Yeah. And I think we ran into that more so once the ACA came about, when all of these micro groups came about, and then they started getting a little pickier, and we actually get audits for some of our groups too. They want to know how many eligible employees were last year, this year, how many are out of state. So they are checking on that. Yeah,
because these are guarantee issue plans, and they want to make sure that if they're going to take a group and be liable for the exposure, that it actually is a legitimate business. That's and the people coming on are legitimate employees.
Right. Okay. Well, good. Well, I think this is one thing that business owners are going to appreciate about the fully insured plans is that there isn't that medical underwriting. So it kind of eliminates that. And the premium's typically just based on age, location, what plan are you picking? What network are you picking? Because each of these companies has different networks too.
Yep, 100% accurate.
Okay, perfect. Now let's get into alternative funding. That is becoming more and more popular, something I know you're a big fan of. So let's say the business owner thinks that their group is pretty healthy. We don't want you to ask because that's private information. But if you think your group is healthy, you can have everybody fill out health forms. I have the employees return the forms directly to me so that the employer is left out of it and they don't see anything on their health insurance forms. But can you explain a little bit more about this alternate funding and how they differ from the fully insured plans?
Sure. But I want to address the medical forms first. So in today's world, I try to recommend using some kind of system that we have access to that can collect multiple forms at the same time. So when Lisa goes in and fills that form out, we actually can populate 7 different forms all at one time. And Lisa signs one, she signs all 7. Nice. That's electronic, so we don't have missing information. It's all legible, and no one has to see it.
That is a great system.
There is no
directly to your company.
Yes, and we have access, and then we can pull it out when we actually go to send it to the carrier secure. So that's usually the way I recommend collecting that kind of data.
Okay.
Now, alternative funding has been around for a long time, and it is nothing really new. And there's a lot of different options. You have the fully insured carriers have their version. You have third-party administrators that have come out with their own versions. And the idea behind it is they want to offer care to the employees, but they want to still rate to risk. Mm-hmm. So the rates are based on how healthy your group is. And in today's world, there's two ways for them to do that. They can use AI to underwrite it, or they can use the medical forms. And it depends on who you're working with as to what option the entity is going to end up using. But the idea behind it is if you are a relatively healthy group, you could possibly get rates and save 20, 30, 40% off of those fully insured rates.
Yeah.
And which gets passed on to the employees. More people can afford coverage.
Right.
And it's a better option for everyone involved. Gives the employer the ability to offer something to his employees that's affordable, but it's also meaningful to the employees because they could actually use it, and it doesn't necessarily have a $10,000 or $12,000 max out of pocket.
Wow. Yeah. So I've seen this with a few of my groups. It has a little bit better benefits. It definitely has a lower premium. And then there is an advantage of you can possibly get a refund too if your claims do run really low that year.
Yeah. That's one of the other big advantages is the fact that you get to retain a portion of the premium you paid out of the claims fund if it's unused. And different entities are going to have different solutions. Some are 50%, some are 100, some are 10. It just kind of depends. Some of them you can buy up to get more of it back if you want. Yeah, I don't necessarily use that as a carrot, really. I use the fact that we can generally see how the groups are running on this platform. So we can see not who is using the plan, but how people are using the plan. Generic medication versus brand name, emergency room versus urgent care.
Mm-hmm.
That way
we can educate the employees and you can address exactly where those claims are running high. I love that.
Exactly. That's exactly the point.
Yeah.
If you look at that just a couple times a year, then you can toss something out to the employees to remind them, hey, you've got unlimited free telemedicine.
Yeah.
Bingo.
There you go. That's the best thing. Everybody has that now.
Yeah. And in most cases it's free and doesn't cost anybody anything.
Right.
With alternative funding, one of the things I will generally recommend is to maybe put a standalone version in alongside. And the reason for that is
Standalone what?
Standalone telemedicine.
Oh, really? Okay.
Yep. The reason being is that a lot of the telemedicine that's offered by these entities runs through the claims fund. So it doesn't matter whether you go to the doctor or you use the telemedicine, the plan is still paying for it.
Okay.
Whereas if you put it outside, then you're not going to end up running that through the claims fund. Everybody wins because it will help keep the renewal lower.
That's very interesting. That's good information.
And some of the telemeds that are out there, they offer multiple levels of service, and all of it is free. And the other reason that you do it standalone is that you're not just giving it to the people who enroll in the plan. You can give it to the whole entire group. And in certain circumstances,
what about family members?
It covers all the family members. Wow. You're right there with me.
That's tremendous.
Great minds think alike.
We've been working together a while. Yeah.
Yeah. And that's important because, the employee may be able to afford the coverage for himself, but he can't afford the coverage for his family. Whereas the telemedicine at least gives them access to care 24/7, 365 at no cost.
And that's a lot. There are a lot of things you can do through telemedicine.
Oh, yeah. 70% of what people go to the emergency room for actually could be handled by telemedicine.
Wow. And that is a big source of claims, right? High claims. I know walking through the door is at least $1,000 at the emergency room.
Generally, these days, it's $2,500.
Wow.
You're just walking through the door, it's going to cost you $2,500.
Yeah, if you look at your explanation of benefits, it's mind-boggling just what these hospitals can charge. But that's a big reason for the insurance is the discounts.
Yes.
When you do have those big claims, or maybe even not a huge claim, but you go to the ER and they're going to run every test on you.
Yep.
And that really adds up.
It does, especially now because the cost of everything continues to increase with inflation and the contracts with everyone. It's kind of a little bit of a problem.
Yeah. And we were talking just before this that there are some things going on with the insurance companies and a lot of different things that are just we're realizing that that's what's increasing a lot of our premiums. This year, we've had 20 to 25% increases on pretty much across the board on our groups, which we've never seen before.
Yeah, it's unprecedented.
Yeah.
And unfortunately, looking into the crystal ball for next year, it doesn't look like it's going to get much better. I think we're going to be in for one more year of this for it to level out.
Okay, that's good to know, to be prepared for, because everybody's trying to budget, and we used to see maybe a 10% increase, sometimes less. Sometimes we'd get a rate pass, very rare. But yeah, to factor on 25%, it's a big deal.
And with alternative funding, that's also one of the things that I'll recommend to people is a lot of people and brokers want to get rate passes when they run well. And I don't recommend that, because we still have inflation and there still is cost associated with everything.
Right.
So you have to allow the entities to build in some kind of increase for the next year to cover increased costs.
Is there flexibility that the groups can put in a 5% increase or something just to?
Well, the carriers generally will do that for you when they issue the renewal. They will generally will give you a 5, 7, 10%, even if you're running really, really well. I think 10's a little bit too much, but I think every group should take at least a minimum of 7 these days.
Yeah, we just have general inflation anyway, and healthcare inflation.
That's just it. And we don't know what it's going to end up being. Trend in the industry is around 12%.
Okay.
So if we're at 7, we're still winning versus the trend,
right?
But it will buffer the future increase, because if you buffer at 7 and then you have a kind of a rough year to where maybe you should have taken a 25, maybe you can get by with a 12.
Okay.
Because you pre-funded it with your 7.
Gotcha.
So there's kind of a method to the madness. And if your alternative funding plan works the way you're supposed to, you're going to get part of your premium hopefully back anyways. Therefore, you just take that and pocket it, and then you pay it forward the next year.
Okay. Now, how many plans can you typically offer with this kind of funding, or even with the fully insured? You could usually offer at least 2 plans, right?
You can
for the small
definitely
groups.
You can offer 2 plans, even for small groups across all platforms. I see an increase in the plan numbers up to 5 or 7 that people are looking for.
Lot, though.
It is. It's hard.
To try to figure out which is best.
Well, that and your employer still has to administer all those plans. So that makes it a little bit tough. I think small groups having 2 or 3 options at most is a good place to be. Sweet spot.
And that's what I can fit on my 1-page summary that I do for them.
which makes all the difference in the world.
You want to try to make this as simple as you can for people.
Yes.
They're doing this once a year. Let's do it and then be done.
Yeah. Having a high, middle, and low option is really more than enough.
An HSA option. Yeah. I like the high and the low, and an HSA in there.
Yep.
Okay. Perfect. Now, alternative funding, does it take longer to set up? Is it quicker to set up?
No, it takes pretty much the same amount of time as a regular fully insured. With some carriers, we can get it done in a few days, and others, it's going to be a couple weeks. A lot of that comes down to the implementation of people into the system to access care. That's really where the timetable gets stretched. Some will do that when they issue the group. Others will do it after they issue the group. So there's 2 steps. Okay. So that's where the extra time sometimes will take. But even level funding you can get, or alternative funding you can get done in a week.
Okay. Okay. That's really good to know. Now we've talked about maybe you can have different types of employees. Where fully insured, you want to have a W-2 employee. With alternative funding, they will accept 1099. And maybe with less hours. Can you expand on that a little? Yeah.
So the alternative funding platform does give you a lot more flexibility with the employees, and the fact that you can offer it to 1099 employees, which you don't dictate really how they work. You
can't.
Yeah. Right. Exactly. So you're offering it to these people who are piecemeal workers or job specific. Most TPAs and or carriers will allow you to cover them. The number that they'll cover will vary a little bit. Some will only do 25%. Some will do every single person in your group could be a 1099. Oh. It just varies across the board.
Okay.
When it comes to number of hours, like the fully insured, most of them want it to be somewhere in the 20 plus. We used to have some options that would go below that, but I tend to advise to keep people in the 20 to 25 realm, because that makes everybody comfortable that they can afford it.
Yeah.
And
that's a good point.
People like to try to help people, but unfortunately they don't think about the fact of what happens if Chris can't pay. the premium and then he gets 4 months behind, then he's not working enough hours. That's a difficult conversation. So I try to help people think about the things that don't come up like that.
So that's if the employee is contributing part of their premium. That's a really good point too. If you're working 5 hours, you may not be making enough for that.
Well, and even if you're working 20 hours, is that going to be enough to pay, $150 or $200 a month because you may have other obligations?
Sure.
And
or priorities at the time.
Yeah. And things could change.
Yeah.
It's just, your hours could go down further. There's just a lot of unforeseen things that can go wrong that I recommend to try to up that a little bit, somewhere in the 20, 25 hour range. Minimum carriers want usually is 25 to 30.
Okay. And that's kind of a standard that we could use.
Yep. ACA law is 30 hours.
30. Okay. And that's considered full-time, even though it's used to be 40.
Yep.
Okay. And then employer contributions. So with the fully insured plans, you have to contribute, the employer has to contribute 50% to the employee, nothing to the dependents. That's optional. Does it differ with these alternative funding?
Nope.
Employer contribution, do they have to contribute anything?
Yes, they still have to contribute the same as they were under the fully insured. Okay. Now, half is loose term that we use because there are carriers that will allow you to do it not on a percentage basis, but actually on an amount per employee.
Okay, like $250 per month.
Yeah, so sometimes it may not end up being exactly half, but it still is a substantial contribution to the employees.
Okay, and you have to watch that too, because if you set it at $250, but then your rates go up each year, you have to keep up with that. Hit the 50%. Okay. Great. So the alternative funding, I think that's just something to talk with your employer, your broker. Somebody, brokers can talk with you. What's the situation? I've called you a few times recently with my group, and who can we even quote with for this setup? So.
And we ask a lot of questions because we need to know a lot more information so that we can give you a good advice, and we're not going out there and showing a product that we can't end up enrolling.
Right. That's what we want it to. We want it to be sustain that for years to come too.
Yes.
Put the right product in and keep them.
Yep.
Okay. Awesome. So I think this is an important part of the conversation too, because these alternate funding plans could have a lower premium, but there's just a lot more involved too. Do you want to talk about other things that are behind the scenes, like stop loss or reporting? Anything like that, just to be aware of.
So alternative funding is based off of the self-funded platform. So it's a little bit scary because you're bringing up self-funding, and certain people who may not understand it are like, oh my gosh, your liability is going through the roof, and you could be responsible for all these claims. But in reality, that's not how it works.
It feels like a fully insured plan.
Exactly. And there's certain people that actually sell it as fully insured, even though that it's not. Alternative funding is designed to allow the carriers to underwrite. And in order to do that, they had to put it on a self-funded chassis. Okay. So there are pieces to the puzzle like there is in self-funded. So you have stop loss, you have a claims fund, you have a network, you have administration fees, you have RX. You don't
have to worry too much about it. It's kind of behind the scenes.
Well, it's packaged. So what they've done is they've taken all those pieces and they've mashed them all together to make one ball that works like fully insured, that just is made up of all these little entities by themselves. And that is what allows the carriers to rate to risk. And that's what allows you to get a piece of the pie back if you run well. And because of that, you've got two pieces that you need to be aware of that are extra. Number one, there are what they call 1094 and 1095 forms that are due to the federal government. That's reporting.
Right.
Your TPAs generally don't do them for you. Some of your fully insured carriers do. Then you also have your PCORI fees. And PCORI fees is a research fee. It's around till I believe 2029. It was designed to help fund research for things like cancer and other health issues. It's a one-time a year fee. I think this year it's $3.84 per belly button annually.
Gosh, that's minimal.
Yeah. So if you have 10 belly buttons on your plan, you're paying $38.40.
Right.
And you just have to report that and remit it back to the federal government. And it's built into your fully insured rates and your individual and your Medicare. All of that stuff is done by the carriers or built in. Because it's self-funded on the alternative funding platform, it has to be pulled out. And so it's an extra step that employers have to do, but all of your TPAs and carriers have come up with a helping hand when the time comes to report that stuff.
Okay. And it's important to hit those deadlines.
Yep.
Okay. Now, I had a group this year that they went to the alternative funding, and then they had a high claim pop up. So then they got this huge increase. It was like 40%. So just for everybody to be aware of too, we just moved them back to the fully insured product, and they weren't on the hook for extra claims or anything.
Yep.
They just they let it run out for how many months? For all the claims to come through.
So the way that alternative funding works when you leave is it's on a 12-month contract. So anything, you keep the plan for 12 months, anything that comes in from a claim in those 12 months is going to be paid. Each carrier or TPA will have a run out period that varies. It could be 18, 24, 36. The longest one is 60 months. All that means is that's the time that the carrier gives for the claim to come in, and they're still going to pay it.
Right, because they don't always file them immediately.
Exactly. It might take them longer. The entities, the carriers, the TPAs, they are actually going to review it at the end of the 12 months, but they usually will give, as Lisa mentioned, a run out period before they end up evaluating it, and then they're going to end up remitting money back to the employer if there's anything left in the claims fund.
Okay.
That usually will take anywhere from 3 to 6 months before they review it. And then it will take 3 to 6 months after that before they give their money back. So it's generally 16 to 19 months after the renewal, after the plan went effective originally, when you're going to end up getting your possible return of the claims fund. And generally,
if you're running well, you're probably going to stay.
Yes. And you have to, with most entities, you have to renew in order to get that remittance of the extra claims fund.
That makes sense.
Yes. So if you leave, you may not get it. If you stay, they will give it to you. And some of them give it in different forms. Some give it in a check. Some give it as a return back into your account. Some of them will take it off of your premium. It just kind of depends on what the entity has decided.
And that's a reason to have you, someone like you. We don't have to learn all this stuff.
We try to remember as much as we can.
A lot easier, Chris. You and Brandy.
I spend a lot of time studying.
I bet. But you remember it all. All right, let's get into section 3. So this is what I think is going to be the biggest surprise for small business owners. So the Department of Revenue offers a premium tax credit to new group health plans for up to 3 years. Will you tell us a little bit about that? This is really valuable.
So this has been around for 10, 12 years. The state of Arizona, 10 or 12 years ago, created an actual fund of $5 million. And it's always $5 million every year. And this $5 million was earmarked to help businesses that have not offered a group health insurance plan in the last 6 months, who have not actually had the premium tax credit in the past, a tax credit of $1,000 for an individual annually and $3,000 for anyone with dependents.
So 2 or more people enrolled together.
Yes.
Okay.
Yep. And they get that amount off of the fully insured only carrier bill. This is a manual process. You have to actually fill out a form.
Which is a quick 1-page form.
Yep. And then you send that back to the state. The state will then issue you a certificate. You have 90 calendar days to submit that certificate to a carrier, a fully insured only carrier.
It's an important distinction.
Your alternative funding plans do not accept this. So this is a fully insured small group, 25 employees or less option to get some free money for the state. You take the certificate once you receive it, and you will then send that into the carrier when you apply for coverage.
So with all the employer and employee forms, it's all submitted as a package.
Yep. We have to submit it as a package. Then it will take roughly 3 months, possibly, because it is a manual process with the carrier as well, for them to adjust your bill accordingly so that the credit will appear. And they will give you the credit from the beginning. So even if it takes 3 months, you're going to see the first 2 months and the third month all come at one time off of your bill to get you current. And then it will be on a monthly basis. Now,
Until it runs out.
Until it runs out. And I say that you're going to see it every month. It depends on the carrier. Some carriers like to take it all right at the beginning. So they literally will not charge you premiums possibly for a few months because they're giving you all the credit up front.
Wow.
And then you will get your normal bill. Others take it off each bill.
I've
And
seen them where they're 50%, they cut your bill in 50% and then just let it run out.
Yep, exactly.
And that credit is a one-time use it or lose it. So this is an important tip. If you're going to apply for that tax credit, make sure you're going to proceed with your health plan. So what I usually do is I run the quotes, consult with the client and say, are we going to proceed with this? Okay, now apply for the tax credit. Like before we're ready to submit the paperwork.
100% accurate.
But there can be a waiting period. So I haven't seen one in the past year, but there can be a waiting period. We've had it in the past.
Yeah, because there's
that $5 million is taken up.
Yes, because it's a rolling five. So it starts at the beginning of every year with $5 million in it. And it's a 3-year program. So you constantly every month have groups coming off, whether they're coming off because maybe they've gone out of business, unfortunately, or they're coming off because they've ran through their 3 years, or maybe they've grown and they don't qualify anymore. You actually, when your renewal is coming up, you have to re-qualify for with the state by sending in a new renewal form to them to show or tell them how many employees you have. And that really is what it's for. It's to so that the employer that had 5 employees the first year, now they're at 40 employees. They're not going to give that group that tax credit the next year. So that money will be available for a new group that is looking for funds.
Now, what if that 5-person group moved to 10 employees? They can get a larger credit the second year?
Yes, because the credit is based off of how you apply. So if you have 10 employees and you only apply for 5 employee only, but you enroll 2 families and 3 employee only, the credit's already been, the certificate has already been issued. Therefore, the only credit you're going to get is on 5 employee amount.
You can't go back and request more money?
Nope. Once the certificate is issued, the certificate is issued. And that is all your money you're going to get for the next year.
Until your renewal.
At renewal, then you can reapply and get more money to make up for that change. So my suggestion is always to evaluate your group before you apply to figure out roughly, what you're looking at, and not make assumptions.
Yeah. That's important too, because you don't really know who's going to elect or if they're going to put their dependents on the plan.
Yep.
So you do need to know that. And because your rates can change too, right? If somebody says my spouse is enrolling and now they're not, or I was going to enroll my kids, which of course have lower premiums, helps kind of bring the composite rates down.
Yeah, that's 100% accurate. And your final rates are based on final enrollment.
So that first enrollment can be sometimes we kind of pad the rates a little. So we don't want to give the employees a bad surprise. We want to give them a good surprise.
Yeah.
Your rates went down.
Yes. Because that happens all the time.
It does. It does. All right. Perfect. Anything else on the small business tax credit? I think we've covered everything.
No, I think to your point that there used to be years ago, there used to be lines.
Yeah.
Especially in the second half of the year, you might have to wait a month or two in order to get it because there were so many groups that were applying. I've seen that number really decrease. We don't have as many tax credits being used now as we have in the past.
Yeah. They're responding really quick within a day, usually when we need a certificate, at least the last 6 months.
Yeah. So I think that there's actually more money out there probably than people think to be able to get a tax credit if you haven't had one before or you haven't offered a group plan in the past 6 months.
Yeah.
Something to look at.
Incentive, right? As people are looking, because sometimes one of our insurance companies provides rates. So I create a sample rate guide. And if somebody's interested in a group health plan, I'm like, here's some sample rates. And usually they're a little surprised that it looks expensive, especially if they've been on the marketplace with a tax credit or they're coming from an employer that has had the employer paying part of the premium. So it's a good way to help offset that. You might get, $5,000, $10,000 in these tax credits for 3 years. That can really help, or a new business that's being started.
Yeah. And that's what it was designed for. It was designed to help those businesses dip their toe in the pool and get a little bit of help to do it.
And one of the big things that I come across with when I'm quoting a new group is people are looking for a PPO. They want a national network. They travel a lot, or they want access to Mayo, and we don't have those things on the individual plans. So this is a way for an employer to get control. What plan do they want to offer? What network do they want? And what are their costs going to be? So this is really valuable. Thank you.
Yeah.
So let's do a quick recap. So the fully insured plans, insurance company takes full responsibility for your claims. There's no medical underwriting. Nobody has to go through that. It's pretty simple to set that up. And then
all age-based.
Age, location. Yeah. Yep. What plan are you doing? Premiums tend to change at renewal. And then alternative funding, you want to hit the highlights on alternative funding?
God, there's so many highlights.
I know the top ones, top five.
Alternative funding is better plan design, possibly cheaper rates. You have to jump through some extra hoops, possibly because it's going to have to go through underwriting. But it's a better way to control costs.
Okay, perfect. All right. Well, thank you for joining us. This has been extremely helpful. I think even brokers will find this helpful today. Or maybe somebody will realize that they can set up their own group health plan.
Thanks for having me.
Yeah. So if somebody wants to, let's say there's a broker out there and they want to get in contact with you or talk to you about these different options, how do they reach you?
Yeah, you can reach me at christopher.keel@emersonrogers.com. And we'd be more than happy to help anybody that needs it. And if somebody is looking for a broker, obviously, Lisa is a great resource. So you want to reach out to her and we can help find a solution.
Okay, perfect. Yeah, I mean, it doesn't cost anything. We talk about this all the time. It doesn't cost anything to work with a broker, typically. It doesn't cost me anything to work with Emerson Rogers. The companies just pay us a commission if we do business with each other. So it's a pretty good deal.
Yeah.
So thank you for joining us again on Health Insurance Sherpa. If you want to reach out to me with any questions, you can reach me at lisa@ecafinancial.com or 602-852-5215. If you found this podcast useful, please follow, like, share. If anybody is going to find this useful, please share it with them. So thank you.